Hi everybody, it's me again. As I told you in my previous video, I got a worksheet here that's got the XYZ company, the income statements, the balance sheet, assets, liabilities, and so forth, as well as the cash flow. They call it the source and application of funds, but it's really the same thing. Now what we're going to do here is we're going to look at the ratios that they talk about in Chapter 3, which I encourage you to look at Chapter 3 and understand where these ratios come from. And the first one we've got down here is return on equity, ROE. And if you look at that, that takes that net income of $184 and it's divided by $1,150 of total equity. So that's a 16% return on equity. Then we got a retention rate. Now the retention rate takes the $184 and you have to subtract cash dividends from it because that's going out. So what's left over is 73% of the 184 stays in the company. Then you multiply the ROE times that retention rate and you come up with this reinvestment rate. And that's a big number. So that's just the 11.7 is just simply the product of 16% times 73%. Operating profit. Operating profit. Now, this one's a little challenging. For example, to come up with the operating profit, it takes that sales to the customer. It doesn't include the 12th interest income and the royalty. And it doesn't include the other expenses of 18. So it just takes the 2,252 sales to customers and subtracts the 1,100 and the 755 and 69 dollars to come up with the operating profit. And that operating profit gets compared with that 2,000 sales to customers of 2,226, and that's where you get that 13.5%. Pre-tax profit is kind of an easy one. Pre-tax profit before taxes is shown there as $310, and you divide that by 2,000, the total revenues of 2,252 to come up with 13.8%. Net profit margin, that's also an easy one. You take that net earnings figure of 184 and divide it by $2,252 of total revenues, and it's 8.2%. That's pretty normal. A new wrinkle here is this equity turnover, which I have not seen before, but you basically take the equity of 1,150 and divide that into the total revenues of 2,252, and it comes up with the 1.92. It's almost a total of 2, what the equity turnover is. From that, we're going to multiply that net profit margin of 8.2% times that 1.96, and we're going to come up with the return on equity, which is shown in this NPM, which is net profit margin, times the EQT, which is the equity turnover, equals the ROE. And you can see that here. You multiply those 8.2% times the 1.96, and you get 16%. And if you think about it, that's exactly how we'll come up with ROE. Current ratio, you all know that. That's current assets divided by current liabilities. And they've got a 2.99, which is really, really good. Capital structure. What they do here is they take this long-term debt and they add it to the total equity of 1,150. And of that total, the total of those two figures, the long-term debt represents 7% of the combination of those two numbers, and stockholders' equity is 93% of that combination. Earnings per share. You all know what that is. There's earnings. The number of shares is 40. Earnings is 184. So earnings per share is $4.60. The PEG ratio. PEG ratio is a little different and interesting, and I'm going to read here that many Wall Street analysts apply a very useful rule of thumb. They compare the company's price-earnings multiple to its long-term growth rate. This calculation is called the price-earnings growth, or simply PEG. Thus, a stock that sells at a PE ratio of 18 with an earnings per share growth rate of 15 has a PEG rate of 1.2. This, which is not too far above the desirable 1.0 figure. Now, it also points out that a PEG of more than 2 is considered high. It means the stock price is too high in comparison with its future growth. And the future growth has a big importance to the value of the stock. So PEG ratio is something we're going to be talking about. Tangible book value is you take the total equity and you're going to subtract that other current assets from it to come up with a tangible book value. You know, the book value is normally of equity is $1,150, but to make it tangible, we just deduct those other current assets because that's considered probably to be not financial, but intangibles, stocks of some, or assets of some kind. Cash flow. Cash flow is net income, net earnings, plus depreciation to come up with $253. Now, enterprise value talks about total market value of stock plus debt minus cash and equivalents. Well, I don't know what the market value of stock, it didn't give it to us, so I really couldn't calculate it, but you're going to take the number of shares and multiply that by the stock price, which will come up with the total value of stock, market value of stock, plus the total debt, which in this case is 85, minus cash of 38 and marketable securities of 200. So that's how that would be calculated. Play with these numbers, study them, read the texture, and we'll talk more about it. Thank you very much.